Hello and welcome to Money Matters TV. I'm your host, Doug Hepburn of Hepburn Financial Advisors, a boutique wealth management firm located in Phoenixville, Pennsylvania, providing trusted advice to successful families, business owners, and individuals for over 20 years. My co-host today, Robin Bond, is unavailable, so I'll be doing the show myself. Wanted to give you a couple of insights as to recent economic indicators that have come out. There's good news and bad news, as you might expect. The good news is the ISM Manufacturing Index expanded, moved from contraction to expansion last month for the first time, reading above 50 in the last 26 months. That's a great indicator because while manufacturing is an important part of the economy, it is unfortunately a smaller part of the economy than it used to be. In the bad news category, we have January auto sales came in at 15.6 million. That was below the forecast of 16.9 million. And December job openings came in at 7.6 million, 600,000 below the forecast of 8.2 million. Now, got to end on a good note. There was some good news recently. The ISM Services Index slipped to 52.8 from 54, which is an indication that inflation may be cooling. Services make up the majority of the U.S. economy, so this is an important factor. And of course, we've talked about this on the show a lot, how inflation has impacted many, many people from 2021 through 2023. The Fed has tried to fight that by raising interest rates. And last fall, they began a new rate cycle of reducing interest rates with the expectation that inflation was coming down, but not fast enough. So they've held it. This indication that inflation is cooling may be a good thing. Now, as part of the strategy to combat inflation, one of the things a lot of people do, and we talked about this on previous shows, is the purchase of precious metals, real assets, as a way to diversify your portfolio and counteract the negative impact of inflation. Precious metals and gold in particular often become popular in times of inflation. This happened. We saw this in the early 80s when interest rates were at double digits and inflation was at double digits and unemployment was in double digits. Gold and silver went through the roof. Some of that had to do with the Hunt brothers trying to corner the market, and they ended up going bankrupt over that. But needless to say, gold is often an alternative for many investors in high inflationary environments and geopolitical risk as a way to hedge those two things. So we've seen a rapid increase in the price of gold, and this has created a lot of interest and actually leads me to our question of the day, which comes from Ed Lewis of Philadelphia. I want to put gold into my IRA, but what companies will do this? Well, that's a great question. And there are plenty of companies that will help you do that. I can't make any specific recommendations. What I can tell you is there are a lot of resources out on the internet. In particular, a quick search came up with an article from money.com posted on the NASDAQ website, as well as another article on bankrate.com on the different custodians that will allow you to have physical gold in your IRA. Now, it's not necessarily the most efficient process because there are oftentimes upfront fees and annual maintenance fees and high minimums. So it's not for everybody. Personally, there are a lot of downsides to holding physical gold, in particular in an IRA. One of them is that gold is metal. It doesn't generate revenue. It is a commodity, so it's going to rise and fall with inflation. So unlike a company that actually, or a gold mining company that's actually mining the gold and making money, your gold is just sitting there subject to market prices, supply and demand. Another component is that, when the gold is sitting there, it's while it's not generating revenue, it's costing you money. Now, that's physical gold. You have the option, as I mentioned previously, to buy into a gold mining company, which may generate revenue while they're mining the ore and producing it for sale. And that way, at least you're participating in the earnings of that company. The other option is to go buy an exchange traded fund or a mutual fund that invests in precious metals. But even when you do that, somebody's got to get paid for managing it. And so there's always a cost associated with it. So my personal preference is, if commodities are something that you want to invest in, make sure that you look at something that's going to be liquid, which, the physical gold in it may not be. And certainly in an IRA, or even if you have it in your house, physical gold may not be liquid. You can't always run down the street and sell it. But the exchange traded funds and mutual funds are a great way to get commodities exposure, have that liquidity, have a manager that's able to make strategic buys and sells when it's appropriate. Hopefully that answers your question. If you have a question for Money Matters today, here's how you can get it answered.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
So in the intro and our question of the day, we talked about inflation. It's been an issue for the past couple of years. And as I said, one of the ways that people combat inflation is to buy real assets, physical assets. In particular, real estate is also another alternative hard asset that you can purchase, and is often in many people's balance sheets. Today we talk about real estate oftentimes on this program because it is such a big component of many people's investment portfolio. So today's guest is from Keller Williams, Todd Reed in Exton, Pennsylvania. Todd, welcome to Money Matters TV.
Hey, Doug, how are you? Thank you. Appreciate you having me.
Oh, my pleasure. How's the local real estate market right now?
Well, it's busy. We're busy. We're getting out of that winter hibernation mode. So December and January have a typical slowdown because of the weather. But, people were out and about. One thing that has not changed for me and most of the country is still a lack of inventory. So it's still a good time to be a seller. I think the sellers love the market. It is trying for the buyers. They may find a property they love and it's on the market 1 or 2 days, and all of a sudden 20 people go out and look at it, and there's 6, 8, 10 offers, and that is still happening. I know it surprises some people that has not changed yet, but that is still how it is. It's very competitive for the lack of inventory, which I was on the show about a year ago this month, and honestly, I know that I said exactly the same thing. And you would think that if you had me here every year, Doug, eventually I'm going to say something different. But for now, it really hasn't changed. It's still a seller's market. We still lack inventory, and it's still not a whole lot of fun being a buyer.
I could appreciate that. I'm curious, from a market perspective, are you seeing a lot of offers coming in over asking price?
Definitely, for sure. So that's common. When you're in a competitive situation and the property is going to get 2 or more offers, there's certainly a buyer out there maybe that has already been outbid on another property or 2 or 3 times, and they're frustrated. So this time they're saying, hey, we're going to do whatever it takes to get this property. So they're going to put a high bid out there and go well over the seller's asking price if they feel that's what they have to do to get this property. It is frustrating for buyers to continue to bid on properties and then get the bad news phone call that, sorry, you didn't get it. We went with a different buyer. That buyer has to start all over again. So eventually it leads to frustration. And yes, the buyers have to bid over full price. And, Doug, I have to understand, I'm not saying that's on every property, but certain properties that come on the market that are attractive, they're in good condition, they're in a good location, they are priced properly. Those properties will continue to be fought over, and buyers will continue to offer over sellers asking price. Yes.
So now you mentioned that there's like a lack of inventory out there. And
Yes.
what do you see that's causing that?
That's a common question. I'll tell you, there's not just one factor. There's no one simple answer to that. But one thing are interest rates. So today on a typical 30-year fixed rate mortgage, rates hover around 7%. All of the folks that might have bought 3-4 years ago or prior, they may be sitting on a mortgage on their current home that's 2.5 or 3%. And they have a problem giving up that rate to go to 7%, which we all understand. All of a sudden, rates have more than doubled, and you would think that would have killed the market, and it basically had no effect. That's how much demand there is, because those high rates would, in a normal environment, every 0.5% that the interest rates go up knocks hundreds of thousands of buyers out of the market. Here we've doubled in rates and the buyers are still out there, but or the sellers, the buyers just don't want to give up that current rate. That's a big one. I'll tell you another one that's not talked about too much, Doug. With so many people working at home now, all the real estate agents like me that have been around for some time, we used to work with a lot of relocation people, a lot of transfers. So if the company was in California and they needed someone in Philadelphia, those people would transfer here. But now so many people work at home, all of a sudden it almost doesn't matter where your company is based. So believe me, the relocation of corporate transfers and just overall transferees, those numbers compared to, if you looked at those numbers from 10 or 20 years ago, they're way, way down. So there's another factor. Lack of new construction. I mean, there's just so many factors why people are staying where they're at. That's just a few.
Yeah, it's interesting that you mentioned that, and in particular, interest rates. There in financial planning, there's a concept known as recency bias, where people get programmed to believe that what's happened recently is going to continue to happen. And I think a lot of people got sucked into the idea that interest rates were so low for so long that anything above 3% is too much. Well, gosh, I mentioned in the lead-in that we saw interest rates at 18, 19% back in the 80s.
Early
7% is a bargain.
That's correct. That's correct.
And even in the 90s, 7% was routine. So for people to complain about these interest rates now is really kind of silly. But I guess if you got to buy a house, you got to buy a house.
Right. And the theory is that if we think, all right, 7% is a high rate, we don't think it will be there forever. So people they're going to go ahead, if they have to make a move, they're going to go ahead and buy a home today with the thought or a game plan that whether it's 6 months or next year or 2 years, someday rates will float back down and maybe we get back to 5%. And then they refinance. So a refinance is always on the table. You're seeing some creative loans come back into play, adjustable rate mortgages, maybe at least for the first year or 2 or 3, the interest rate's discounted. And yes, it can go up, but Again, if the overall market is down, maybe they can refinance. It's an
Yeah,
option.
that's yeah, and you mentioned adjustable rate mortgages. I mean, sometimes that I know back in the 90s, Alan Greenspan thought that was or the early 2000s thought that was great because, people were able to take the risk the risk premium off the table from a 30 that is built into a 30-year loan. But there's always that downside that, once your fixed rate is gone, you're going to adjust, and that adjustment may not be comfortable. I'm curious though. I mean, is this lack of inventory, is that something that's just regional, or because, you've heard the location, 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 the three words behind real estate. Are we
It's
seeing
not. It's not just regional.
really?
It has been a national problem. Again, I'm in the mid-Atlantic market, close to you, just west of Philadelphia, and there's certainly a lack of inventory here. But that has been a countrywide problem. It really started somewhere in that COVID area. Like, seems like everything you talk about has something to do with COVID. Here we are,
Right.
a few years later, we still keep bringing that up, and I hate to be a guy that keeps bringing it up, but that's kind of when everything changed. And there is definitely a lack of inventory in most of the country. Now, there's always going to be exceptions. I know Florida had a lack of inventory, but they had a couple tough storms down there, and I know that's changed their market. Getting insurance in some of those areas, LA, California,
Right.
Florida, with some of these natural disasters that we've seen, just getting a property insured is now a problem. So there's going to be more inventory if, there was an event that maybe hurt the market in a certain area. But most of your typical real estate markets in most of the country have the same problem. There are more buyers than sellers. People are paying rent, and they're paying rent that they don't want to pay. Again, in our area, it's not uncommon for folks to be paying $2,500, $3,000 a month for rent. That's not really what they want to do. They would much rather buy a home, but with this lack of inventory, they're stuck in these high dollar rentals. And it's not just here, Doug. It's not just here. It's most of the country.
Yeah. Well, you raise a very interesting point with the carrying cost of real estate going up, particularly in those places that have been hit by natural disasters, Florida in particular. I know several instances where people had seen property values actually go down because the number of sellers wanting to get out of condo communities because the inflation cost has gone too high and their condo fees have gone too high for a lot of the residents there. Obviously, it's unfortunately in California, and we certainly feel for the people who've been impacted by the fires out there. But that's a whole lot of inventory that's off the market, and a whole lot of people who are looking for new places. So that's going to be very disruptive. And from what I understand, these natural disasters are not just going to impact residents in those localities, but you can probably expect to see homeowners insurance and casualty insurance go up across the country, regardless of whether you're in a hurricane or fire zone.
Guaranteed. And I think that's already happening. Yeah, that's for
Now,
sure. Expect your homeowner's insurance bill to increase. The insurance companies they're paying a lot of claims right now, and they're about to. So the premiums can only go one direction, and that will be countrywide. Yes.
Right. Now, in terms of, we talked about this from the supply side. Obviously, the demand side is pretty big. You've got a whole new generation of people who want to buy new homes so they can get out of apartments. But one of the things that we've seen is one of the fastest growing areas of in real estate construction is multifamily. So, is there a lot of single family building going on that's in that starter home market?
I can only speak for my market. No, there's nowhere near enough. So there's new construction here, but I'll tell you, as far as introductory level pricing, there's almost none of it. So, all right, there's a lot of new construction where I'm at 700,000, 800,000, a million, plenty of that. But if you're a buyer where your budget is, let's say 300,000, 400,000, you have almost zero options here for new construction. You are forced to try to look for a resale, because there aren't any new homes being built that we can attach the word affordable housing to those. No, and there's several reasons for that. The cost of construction, the cost of a builder to improve ground, the cost of a builder to purchase ground. We can't just say, hey, everyone build $300,000 homes, because we really need that. The builders need to make a profit. I mean, that's why they're in business. So,
Right.
with all the costs involved to build, and the builder needing a profit, affordable housing right now for new construction it's just not here. It's not in my area. There really isn't any.
Yeah. Yeah. That's unfortunate. And I understand that. I mean, obviously, as you said, the builder's got to make money, and they're going to go to where the margins are highest.
Yes.
What is it that potential buyers or buyers can do to sort of position themselves to win these bids?
Yeah, and good question. We're always talking about that. Here's another thing that I wanted to say, Doug. Right now, nationally, the amount of cash bids that are accepted is up near 40%.
Wow.
So back to the multiple bid situation. The seller gets 4 bids on the property. 3 of those 4 buyers, they need a mortgage, like most people. They
So
might
the
have
contingent on financing.
exactly. They need a mortgage, even though they're probably pre-approved and they're a good candidate to get a
Right.
mortgage, which should not be a problem. They're going to put their 10 or 20 or 30% down. But all of a sudden, in these multiple bid situations, one of the buyers has all cash. He's sitting on the money in the bank or an investment account that he can liquidate, and the buyers that need that mortgage can't compete against the cash buyer. So that's another thing that's happening right now. So I would tell the buyers, the more you can save, the better. So when
Right.
you go to bid on a property, there are still certain mortgage programs that are 0% down or 3.5% down, or maybe only 5% down. So those mortgage programs still exist. The problem with that is, again, when you're up against other buyers that may have more money down, those buyers look more attractive to the seller. So the seller wants the most ironclad deal that they can get. They don't want to worry for the first 30 days of the transaction. What if the buyer can't get a mortgage? What if they get turned down? We've been off the market. So the more money these buyers can save, the better off that they are. Work on credit scores. Your financing now is somewhat credit score driven. The higher your
Okay.
score, the less your fees.
Sure.
So again, if two buyers today might go to the same lender, and the lender tells them, hey, you're both at 7%, but the buyer that might have a 650 credit score has a whole bunch of extra upfront fees that the buyer with a 780 credit score does not have. So saving money for buyers, getting your credit score as high as you can, put you in a better position when you put your bid in front of the seller.
No, that makes a lot of sense, and that's certainly something that we recommend to people. Manage your credit score and manage your credit properly. I was just thinking, because I went through this with a client. For those people who are downsizing, and I think we spoke about this in the green room. The only thing that's going to bring inventory back onto the market is if somebody dies or decides to move into a retirement community, because people in that middle market, they're not ready to leave because they want to keep their kids in the same school district, and they've got their low mortgage. But recently I had a client that went through and actually got a buy before you sell mortgage. So their current house was paid off. They had to buy a new property, and they were able to get cash out of their old property to buy the new property. Have you seen that at all?
Oh, there are some creative programs there. They're part of that is the buyer's financial qualification. So, the lender's probably going to say in certain situations, to be able to do that, you better be able to show enough income to potentially carry 2 mortgage payments. There is creativity out there, but depends on your buyer. If your buyer is the other thing, your sellers that are sitting on a lot of equity in their current home. So yes,
Right.
It's almost like a home. We used to do a lot of home equity lines of credit. You don't see that as much anymore, but that's kind of what you're talking about, where they can in advance find a way where they can pull the credit out of the equity out of their current home to go ahead and buy the other home first. Once they have that transaction secured, then they can go back to their home and say, all right, now we'll sell our home. Yes, there are creative programs out there as long as the buyer meets the lender's criteria.
Yeah, no, that's good. That's good stuff. Just to sort of wrap up, and I know if I asked you this question a year ago, it'd probably be the same as it is now. But if you were to look at a crystal ball, what would you see in the next 6 to 12 months?
I knew that question was coming, Doug. I knew it. If I had that crystal ball, I might not be here talking to you. I'd be somewhere warmer. I know that.
Or in Vegas.
Yeah, exactly. I'll tell you what's coming. It's not going to change in the near future. There's no way that overnight we can go from this huge lack of inventory to all of a sudden, hey, everything's just fine. It's going to take time to work itself out. How much time is that? I don't know. It could be years. You're right about some of the older population. So the baby boomers, and I call it the last year of that era, should be retiring and should be downsizing or going to retirement homes. So those properties should be available, and even there aren't enough of those. So I don't know what's coming. I can tell you, until our inventory changes, it will continue to be strictly a seller's market, and the sellers are reaping the rewards of getting more than they ever dreamed of for their home over their asking price. Most buyers now are forced to buy without inspections. That's a scary thing for buyers. Of course, the sellers love it. So, the sellers make all the terms in today's world.
Right.
And, that's how it will continue. As long as they have, again, a good, clean property and they've kind of priced it pretty much in line with where it should be, it's going to be tough on buyers for a while. But hey, you need to live somewhere. So whether you're in a rental or have a mortgage, if you have to have shelter. So I don't think buyers should be afraid to buy homes. And if that mortgage interest rate's high, hopefully someday you can refinance that. Let's get that down in a couple of years. The market will change, Doug. When is no one knows.
Well, Todd, thanks for your insights and giving us a better understanding of the residential real estate market here in the Philadelphia area. It's been a pleasure having you on Money Matters TV. I'd like to thank all the people who work in the background here to make Money Matters TV happen. And most importantly, we want to thank you, our viewers, for tuning in. Our next show is going to have Jeff Watkinson of Watkinson Capital Advisors. So thanks again for tuning in to Money Matters TV, where your money matters.
Thanks, Doug.